Every trader needs to know exactly where they are entering and exiting their trades, and in this episode of my order flow series, I want to go over how I create levels of interest and then interpret the order flow and price action to find levels that give me an edge. This is going to be a really good lesson on the methods I use to not only locate levels of interest, but how I format my trades based on these price levels. Finding good setups is not just about identifying a resistance or drawing in a demand zone, but viewing how the price action reacts around these levels and then creating a trade plan that both defines your risk and your reward. Before I begin, I ask if you can all go follow me on my Instagram. I post really great trading tips and trading recaps, which can be a really great resource for you to learn from. Now with that, let's get into how I locate levels of interest. All right, now let's go over what I use to create levels of interest to find trades from. This is what I'm going to go through in this lesson. I'm going to kind of show you just the main methods or ways that I use to identify levels to trade off of. We're going to talk about some things that you've probably heard of before, like supply and demand, support and resistance, Confluence. My goal is to give you like kind of more of a creative way to look at it. I'm not just going to tell you how to plot support and resistance. That's not the point. It's more so like, how do I identify these levels and like use them to create trades and then like make trades from. So the goal is to give you value. You probably haven't heard of certain things like the weekly expected move, maybe like delta outliers or like different types of profiles, low volume nodes. So hopefully, so whether you're like a beginner or like you kind of been trading around, this is going to be a good video for you to learn. But the main things that I'm formatting my levels from are supply and demand zones, the weekly options expected move, support, resistance, and confluent levels, the Globex high and low, the open, high, low, and close, delta outliers, and then profiles like low volume nodes, the point of control, and consolidation structures. And these last ones are kind of like more order flow based. And then before we begin, I'm going to give you guys a free like indicator pack and preset templates. So just click the last link in the description of the video and you can receive that. All I ask from you is for your email and I will send you the pack. Don't worry, I'm not like a big email marketer. I'm not going to blow you up with emails. You're going to put your email in and then you're going to get the indicator pack. Included in that will be the weekly expected move study. This is probably the most useful one. It's for Thinkorswim, as well as the prior day close study, the prior day high and low, which plots that on Thinkorswim for you. You don't have to draw those in manually. And then if you use Motive Wave, I'm including my volume profile preset. So you can just load that template in and it'll be ready to go for you. Okay, so how do I create levels of interest? So the key point I want to make with levels of interest is using them to create a trade thesis. We find our levels and then we want to make a creative analysis based on the data, based on the trend of the day, whether these levels are going to hold, if we want to take them as they cross through, if we want to use them for a back test, like support and resistance, like what is the most sort of logical or creative way that we can use these levels to format a trade analysis where we can define our risk and a profit target and make trades off of. We use technical analysis to determine at what price levels are bulls or bears comfortable or in pain. This is kind of key. We talked about it in the first episode of the order flow series, and I've talked about it like in the footprint and bookmap videos, where I want to be on the side of the most pain. All right. So if we are moving up and there's a lot of buying up here, but there's no effort, maybe we're at a supply zone, maybe we're at resistance. I see a ton of buying. I want to see a ton of buying and then know that if we come down, all that buying is going to be put in pain. And as we move lower, they're going to have to stop out and fuel them move lower. And then that's when I want to be short. I don't want to be short if there's a lot of buying and we just keep trending up and keep trending up. I don't want to be shorting and then getting stopped out if the bulls are comfortable. So I'm trying to identify like where is the comfort, where is the pain, right, based on my levels of interest. And then when we identify these areas where price action gravitates towards, we use that to create a bias, right, above or below, bull or bear. So we have like, let's say a main level, and above this level, I want to look for longs that kind of come back down and back test, and I'm going to like be a dip buyer. And then below this level, I want to kind of look for trades that come up and then reject and then go lower. All right. And that kind of helps me determine whether I want to be a bull or a bear, and then whether I want to short rallies or buy dips. And then I'm watching the reactions at those levels, like for sweeps, breaks, and retests. So like, what is a sweep? A sweep is where we trend up, we come up fast, and then we come back down really quick. And then maybe we trend lower from there. A break and a retest would be like, we come up, we break out above this level, we come back down, we test it, we hold, and then this is my entry long for a move back up. And then a break and a reclaim would kind of be like a break and a reclaim. It's kind of like a sweep. How I play it is like, let's say we have a price level down here, and let's say there's another one right here. So we break this level, but we don't break this level, and then we reclaim this level up here, and then that is my entry long because we're defending this price, we're reclaiming this one, and then we continue up, and I'll look for a long. That's kind of how I play those. And then using if then statements. So kind of like in that example, like if 6,000 tests, let's pretend that's 6,000, and this is a really bad 95. If price comes down, let me change the color. Price comes down, and let's say it breaks below 6,000. If it breaks below 10,000 and then does not break below 95 and reclaims, if it breaks and then it reclaims, then I want a long up here into 60.20, and I get in long right here for a move back to 620. That's kind of how I would view like an if-then statement. If you can format your trades with this if-then, you add this layer of confirmation to where you're not just buying at 6,000 and holding and hoping that it bounces there, but you're letting 6,000 hit, and then you're observing the price action and seeing if your other levels can hold. And of course, I'm looking for like pain and comfort on the order flow, if there's a lot of buying or selling on the order flow to help confirm. But once 6,000 tests, now I'm watching to see, okay, does 95 come back down, or does 95 hold and then we come back up above 6,000? So more on creating a trade plan. So here's an example of a trade that I took, and we can look at the timestamps. This is like before it happened. This is the chart. I don't have the demand zone drawn in, but like the demand zone is kind of like right here, 530 to 527. So at 734, which is like kind of like right here where that green dot is, I was like, all right, I like a move into 59.30 to wick out the daily low, which was right here. And I want to see it break 59.30, which is this demand zone, and hold 27.5 for a move back up. And there's a lot of negative delta, so a break and reclaim could be nice. I just kind of talked about that break and reclaim. There's a lot of negative delta, as we can see on the depth of market. There's a ton of selling. So there's a lot of selling. So these sellers need to put in effort and continue this lower. If they don't, then they're probably going to be put in pain, and we're going to move up. And this is in the context of a very bullish trending market. So I have that kind of behind me where dip buying is working in this marketplace. So it broke the demand, and then and this is a good context because my demand ended at like 28, but the low was like down here at 25. But this reclaim happened so fast and it was so quick that I viewed that as bullish, and a break of demand wait now for 23. I was gonna wait for 23, which was the Globex low, but it's floored at 25, and then it went back up really fast. And I go, okay, my trade plan's playing out. It's not going to be perfect every time to the tick. And so I got long at 30 on a break and reclaim with my stop under the low day at 24.50. And then I ended up closing this trade at my Confluent level, 59.44, right here, about 45 minutes, 50 minutes later. And so that was my if statement, right? My if then. If 59.30 breaks, but we can hold this demand zone, then I will take it long into this level up here. If then statement, and that's how it played out, using the order flow to help aid my context and my demand zone. All right, supply and demand. I'm assuming a lot of you know this. If you don't, I have a free video on my YouTube going over how to trade supply and demand. So you can just go find that video on my channel. But I use supply and demand zones. This is just kind of a picture of, I draw them in, and on these balance days, you can short here, short here, short here, and you can buy at demand and just kind of like trade in between these zones. And that's like the simple way to do it. Here's a really good picture of supply and demand zones and why I love using them. So we have this day, we open up, we hit this supply zone, and then we sell off into the demand zone, and then we bounce up. I mean, price is always moving between supply and demand. And as we saw in the example on the last slide, it helps me really generate context on where I want to get long or short. I don't want to short down here, and I don't want to buy up here. It gives me levels to trade to and from, and it helps keep me from getting in trades. I'm going to show you right now. So in this session, I got long at like 44 right here. And then this was going up and down, up and down, up and down. And it was very annoying as I posted. But I was going for a 58.25 target. And then I kind of realized, there's supply at 30, or is it 53 right here? So when I was kind of in this downturn right here, I was like, given supply at 53, I'm going to close fully by 59.54. My stop remains break even. I probably should have closed at 53 given this PA, but anything can happen. And I closed out all at 52. Clear ceiling at 53 and bad price action. I'm going to take what I can get. And then, I was following my trading plan, even though this was going up and down. I didn't get shooken out and I held to my profit target. And I should have sold at this supply zone. No one knew we were going to drop this much on a bad bond auction. What it did is I had a higher price target, but I just kept it simple. I got a supply zone here. Why am I trying to hold for higher? Let me just get out at 52 and take my win. And then we came down into this demand zone, and then I got long at 80, I think right about on this candle right here, because we kind of came back down. We back tested the demand zone, and then we pushed up very fast, and I was out for 10 points pretty quick. That's trading the demand zone. I had this bias level at 76 on my chart. So I was long 80, stop at 76. We get this bounce in demand. Consequently, it held perfectly. What do you know? Perfect little hold at the demand zone. We break back up. We back test into it. We get this pop. I get a quick trade out of it, and then we come back down. And so that was a trade, 2 trades that I took. But using supply and demand to kind of help me from holding too long, giving me context on where to exit. And if you're not in a trade, I mean, this is a great short always. And then when it comes down into the demand, I know not to sell anymore, and I'm looking for a long. All right, the weekly expected move. This is a really good one. And this is probably going to be the thing that a lot of people don't know about, perhaps. But the weekly expected move, all it is the options market weekly expected move. It is a 1 standard deviation move, and it is the market maker's happy place for risk is inside the EM, the expected move. There's about a 68% chance that we close inside this range each week. I wrote range wrong. We're going to just X that out, pretend that didn't happen. And the market maker must buy into buying and sell into selling when we get too far outside that range to remain delta neutral. So on Thinkorswim, and this is on TradingView and stuff too, but I use Thinkorswim, so this is my example. It's the Friday expiration. So this was Monday. So the Friday expiration, it shows it on this corner right here, basically saying by Friday, the percent is the IV, but by Friday, we're going to go up or down $88. What it's telling me for tomorrow, like even for 1 day away, there's an expected move of $44. And by Friday, the SPX is expected to go up or down $88. That's all that is, and it's a 1 standard deviation move. If you get that free pack in the description that I'm going to email you, you'll get this indicator which plots it automatically. Now, if you use this indicator, you have to be on the daily chart. It's going to look really messy. And I manually draw in the lines each week to affect the prior close, which is the prior Friday close, the upper and the lower end of the expected move. And so we can see on this, it's a 1 standard deviation move. So for example, like if this is our bell curve, if this is our line, you have like your bell curve like this, all right? Here's your middle, there's your upper expected move, that's your 1 standard deviation, and there's your lower expected move, and that's your 1 standard deviation. And when you get these moves outside of it, down here, that's like your 2 and 3 sigma moves, as they call it. I'm not a mathematician, but these are your extended moves. And so these give you really great points to trade from. For example, here's the open. We open down here. If you're long, let's say you're long on this Monday, this is before all the tariff craziness. You're long on this Monday, Tuesday, Wednesday. Wednesday, we hit the expected move up here. The probability of us going up is very, very low at the upper end of the expected move because the market maker's happy place for risk is inside of this move. So when we get to the top of these ranges, I'm looking to close out positions, calls, longs, whatever. Or if I'm looking to open potentially shorts, kind of like right here, how we opened up, we went to the top of the expected move, we skated it for 3 days, and then if you're short Tuesday or Wednesday, you get paid Thursday or Friday. If you're short by Wednesday, you get paid Thursday, and then on the tariff day, you got really paid. The next day we opened, on Monday, we hit the lower end of this move. So at this point, I really don't want to short because we're where we're supposed to be on Friday. So it's a good chance the market maker is going to balance back inside of this range and bring us up. Which is what happens Monday, Tuesday, and then Wednesday, we go up here. So it gives you context to, hey, it's Monday, we're underneath the expected move. I should not be shorting into this move. You can look to buy potentially. And so you can just see the relationship that it has each week. Here's the week we gapped up upside the expected move. The market maker has to buy and buying, and we just kind of kept skating up because we're outside the expected move. Here's a week where we came down, we bounced at the bottom, and then we closed in the middle. Here's a week where we closed underneath it, and this was a particular week where we kept kind of rejecting the expected move, and then we ultimately closed lower. And then we did the same thing on this week. But if you notice this week, we opened and we came down, but where did the week close? The week closed exactly where it was expected to, at the lower end of the expected move. So you watch this enough, you can get really good context on where the market is going to go. You can trade butterflies if you know what those are on options. It's kind of like pin the tail on the donkey, to where you can do like a call butterfly or a put butterfly at these price levels and try and nail them to hit. And if the SPX closes around this level quite often, we had to close right here, we had to close right here, so we had to close right here. So I'm drawing these levels in, and it's helping me create context on where the market is going. This same chart, there's a level I had drawn in. What do you know, on the first test, you got about a 10-15 point rally, came back down, and then of course we had a bounce again. And actually this day, I don't have the chart. I mean, you can go look. It was the 21st. We closed at 58.54 and 50 cents. So on Wednesday, we closed exactly at the lower expected move. I'm just making the point. They're very powerful levels, and you should include them on your charts. And so I posted this at 11:20, which was right here. There's 11:30, so right in this range. The next main level is the expected move, which sits at 58.54. Watch this overnight tomorrow. The market maker's happy place for risk. It's inside this level into Friday, so underneath we can expect to balance back inside the range. Under this, the market maker has to sell into selling to remain delta neutral, but SPX matters most, which we're under. That lower EM was 58.63. Key point here. So the further away we get from it by put buyers, the market maker has to sell ES futures to keep their books balanced and delta neutral. So what's happening here is you have a ton of people buying puts on the SPX. All right. And when you buy a put, you are agreeing to sell shares at a lower price. And so when you are selling shares, the market maker has to sell you those puts. And when they sell you those puts, the market maker is agreeing to, I'm going to rewrite this. Yeah, I rewrote it. When you buy puts, the market maker sells you puts. And when they sell you puts, they are positive delta, because when you sell a put, you're going to buy shares at a lower price. In order to offset this positive delta, they have to go and sell ES futures contracts to become negative delta. And then that makes them delta neutral. So when you sell puts, market maker is positive delta, and to offset that, they have to sell ES futures to get negative delta. And it's the same thing for the upside. All right. When you are a call buyer, the market maker is negative delta because they are selling you the calls. So in order to become positive delta, they have to go and buy ES futures. So as we move up, the market maker has to buy ES futures so that they can remain delta neutral. So when you have tons of call buying, tons of call gamma, market makers can buy into buying. When you have tons of put gamma, the market makers can sell into selling outside of this expected move range. That's basically kind of how that works. And here's just another example. It totally works on equities. I draw them in every week on Apple, Nvidia, Tesla. This was Monday open. We went underneath the expected move. What happened when we reclaimed it? Apple went up the rest of the day. So if you're short Apple at the open on Monday, and you start to see us hang out by this expected move and come back up, you do not want to be short, because the probability of it going lower is not as high as the probability of it going up is, because the lower expected move is there. If you don't know that and you don't know what's going to happen, you're probably just going to short this and continue to think it's going to go down. They're pretty good levels to trade off of. And then I'm using support and resistance and Confluence. And really Confluence, all that kind of means is it's like support and resistance for me. It's a big level. You know, like this is a balanced range here. This 44 is a big level. Resistance here, we sell under it, we come back up, we come back into it, we sell, and then we come back again, and then we trade up above it, and we're just kind of like going around this level. It's like a gravity point for me. Same thing with like 76, how it's it's resistance. We have a breakout from it. We back test that resistance. It becomes support. So it's a bias level for me, where as long as we're above this, the bulls are comfy, and if we're below it, then the bulls can be put in pain. So all the people that are buying up in here, as long as we're above this level, they're not really worried. But once we break underneath this, then it becomes scary. And the main thing with this, I mean, this is, I post this every morning. It's my pre-market plan. I notated 59.54 means a critical level that can be used to short from below or buy from above. And then this was a day we trended up and we went above it, but I was not looking to short even at this supply zone. Implication of 59.44 and the daily game plan has kept me from shorting, now watching the 77 reaction. So my bias level here, again, if then statements, where can you buy from above or short from below from? So as long as we're above this level, I really don't want to be a seller. But once we're underneath it, I can become a seller. So this level alone, seeing the reaction at it helps me format my trades so that I'm longing and shorting where I'm supposed to be, and I'm not FOMOing into a move, right? I'm not just shorting this high because we're so high, we have to come down. It's like we're above this level. I don't want to short. When the sellers can show conviction and bring this down and like back test this level and then go lower, then I want to short. I don't want to short up here. I want to short when we move down and we fail this level, and then I want to go for a short down there. That's the higher probability setup for me. The next thing I use is the Globex high or low. This is the high of the overnight session and then the low of the overnight session. As we can see, the low right here pretty much was a floor above this demand zone all day. So two pieces of context there, demand zone and the Globex low. And we had 1, 2, 3, 4, 5, 6, 7. I mean, 8 different times you could have bought this level. And these balance ranges in between supply and demand, I mean, you can make a living kind of buying here, selling here, not holding for massive profit targets based on the context of the session, based on the balance range, based on the hold of the Globex low. I mean, seeing all this, I don't want to short down here. Trading is as much as it is finding good trades as it is avoiding bad trades. And if you have a short bias and this is going on, those are bad trades. You do not want to short down here. You want to short up here. You do not want to buy up here. You want to buy down here. Now, delta outliers. So this is from the footprint section. If you haven't seen the second episode, it's going to make a lot more sense if you've watched that. But I'm looking for outliers in the data on the footprint chart. We talked about trap buyers, where if you look at this, there's not a lot of buying. There's a 250 here, 34, 46. But when we get to this high, there's a ton of effort by buyers, and then it comes down, and then heavy selling steps in after it. These are areas I can look to short or to close out longs. We can see it on the profile right here. There's a lot of effort by buyers, and then we kind of come back down below the open of this candle, and then selling kind of steps in, and then this thing moves lower. We can see more outliers on the depth of market and the footprint chart. So I have this lined up. So the depth of market, which was the last episode, and now we're going to look at a large delta outlier, which you can see in the footprint and you can see on the depth of market. So this 59.50, which is the total right here, 15.17. A lot of buying at the 59.50. We can see it on different footprints throughout trading. And then here's a large buyer at 59.50. So we're moving in and around this level. And the idea behind this is that, this buyer is comfy above his price, but once we get below his price, then he can be put in pain. So from here, the context I'm going to look at, there's my big level at 59.44. If this can reclaim above 50, maybe we can take out the highs, maybe we can chew through this supply because this guy is comfortable. But if we come into this level and we fail and we start to move lower, or if we just fail from right here and we take out this low, then I'm going to have to look to short because this buyer is going to be put in pain and he's going to have to stop out and fuel a move lower. And then this is the result of that under 59.50. We broke this low, and then we had this huge sell-off because this buyer and everyone up here were forced to close and stop out of their positions. And as we went lower and we broke through all these support levels, those buyers are getting stopped out. So you see these big price levels, and you mark them on your charts, and then you can create trade plans off of them. If-then statements. If this cannot break 59.50, I'm going to short. if this gets back above and holds like it is right here, then maybe I can get a long in. And in this case, we broke the low, we broke the consolidation range, and then we went lower. And then one of the last things, which you can really see in Bookmap, is consolidation structures or low volume nodes. So this was at 720, which is right here. I'm posting before the move. These 36 interest me, the consolidation structure and a low volume node below the news sweep, and a move back into this that fails that could look to retest under 27s. So we have this consolidation structure, which is where we're just kind of consolidating back and forth. We had this big news sweep. We have a big passive seller here at 59.40, and we have this low volume node, which is right above this consolidation structure. And so to me, I view this as not a lot of interest to take it higher because there's low volume there. So the sellers can take control. So if this comes back up into this level, into this range, and can't get above, this seller at 59.40, then I want to look to short and go lower. And this is the implication of that. So here's 36. If we look at 36, I mean, there's technically a 2-minute supply here. I'm not going to really look at that. I have no level at 36, yet this rejected perfectly, and it went down all the way to 20. I mean, that's at a max of 15-point trade. And this is something that I called out before reading the order flow. Consolidation structure, there's a big news sweep. There's a low volume node above this structure. There's this passive seller sitting up here. If this comes back up, there's a good chance, as long as we can reject this. If this rejects, then I would like to short and go lower. It came right back up. It rejected, it shorted, and went lower. And that would have been, I mean, it swept this low liquidity right here and went up. So that's your exit plan. I mean, I would put my take profit down here. I might have got out at the 24, 25s, a quick 10 or 12 point trade based on the lower volatility of the session. This is why you place your stop though, because if you don't put your stop to break even, you're just going to get stopped out anyway. But this is how I trade. But depending on how you trade, this is how I trade, where I'm just kind of looking for 10, 12, 15 point moves sometimes based off of the order flow. We get this move, you short, and then you close down here at the 22s, 14 points, done. And the last thing I'll look at is volume profile. So in the indicator pack, in the description, I'm going to send you this template. You just load it into MotiveWave. It's going to look like this. These are daily profiles, and then the candles are an hourly chart. This yellow line in the middle is a point of control, which is where the highest volume was for the session. And then the shaded area is the value area, which I have set to 40%. I'm going to show you why. And what I'm kind of looking at the bottom and top of this range and the point of control. And so at the bottom of this range right here, draw a line over. Where did we reject? Right there. And so I'll kind of mark these levels out. Sometimes it gives you levels to trade off of. You draw this line, bottom of the VP bottom or balance range low. You can short there. I think here's the high of this one right here. We kind of defended it right there. We came back down into it right here and we went up. This one right here, there's that yellow line. There's the point of control. Where did we reject? Right there. So if you look at this and you have like the prior day's point of control mapped out, you can find a top tick short trade and it can give you levels to trade off of. And that's kind of the main thing I'm looking at on these profiles is just the top and bottom of these ranges and the point of control, and then seeing if I can kind of find areas to trade off of from them. And I'm always confirming with the order flow like we talked about and using if-then statements to find these trades. The better information you have on your charts and the better levels that you have, it just helps you format your trade plan and your thesis so that you can just take better trades. So that's kind of how I'm using volume profiles, and just to kind of see the overall trend where the volume is situated at the highs or the lows of the session and where the low volume nodes are. Like there's a low volume node right here. There's a low volume node right here. There's a low volume node right here. Oh, we rejected it. So I'm kind of looking for the low volume nodes and the high volume node areas when I look at this, just to give me better context for the session so I can format my trades better. So that's how I create levels of interest. In the next video, I'll be going over how I use these levels to get great entries and exits and then manage my risk to get good risk and reward setups. The next episode is going to take everything that we've learned in this order flow series and then apply it to actually taking trades and then managing your risk. If you're looking to level up your trading, we have our full-time trader course, which gives you access to the Discord where I keep everyone updated on my thoughts and trading through the day. It's a more personalized approach to learning where you can interact with like-minded traders. The goal of the Discord is to accelerate your learning curve so you can learn from the course lessons and then take your own trades, just like this member did right here. That'll be the first link down below. With that, I'm ending it, and I will see you in the next episode.